Hello everyone, welcome back. In this video we will be covering the second half of Lecture 9. The topic is still option price decompositions. So, prior to the break we learned about how to decompose an option price into two components. The first was something called intrinsic value, or the tangible value of the option, and second, the time value, the amount of value attributable to the amount of time remaining on the contract. We then learned how to break time value into two separate components, one which was deferred payment value, or deferral, and the second was potentiality value, or potentiality. Okay. In this half of the lecture, we will now relate intrinsic value and time value to two concepts. The first is something called the moneyness of an option, and the second is the early exercise of American options. Okay, let's get started. So options are commonly quoted in terms of their moneyness. The moneyness of an option refers to the position of its intrinsic value relative to zero. We say that an option is in the money if the intrinsic value is positive. We say that an option is out the money if the intrinsic value is zero. And we say that an option is at the money if the intrinsic value is both zero and the underlying asset price equals the strike. Here we'll usually deal with stocks. Okay, so to figure out the moneyness of an option, we need to calculate its intrinsic value. So that means we need to know whether it is a call or a put. Okay. For a call, the option is in the money if the intrinsic value is positive. This occurs whenever the current stock price, S, exceeds the strike price, K. It's whenever we would exercise the option. The call option is out the money if the intrinsic value is zero. This occurs when the stock price S, the current stock price S, is below the strike price K. Finally, the call option is at the money if the intrinsic value is both zero and the strike is equal to the stock price. This happens when the current stock price, S, is equal to K. For a put, it is the exact opposite. For a put, the option is still in the money if the intrinsic value is positive. For a put, the payoff is max K minus S and zero. So the put has positive intrinsic value whenever the current stock price, S, is below the strike price, K, which we have the right to sell at. The option is out the money if the current stock price, S, lies above the current strike price, K. And the option is at the money if the intrinsic value is both zero and the current stock price, S, is equal to the strike price, K. Now, what do we use moneyness for? So moneyness is mainly a quoting convention. So for example, dealers will quote you options oftentimes in terms of their moneyness. So for example, if you go on a brokerage site, a dealer might quote you the price of, say, $25 for an at-the-money call option on Apple. What this quote tells you is that the strike of this option is always going to equal the current stock price. You'll know where the current stock price is. Okay. So that wraps up our discussion about moneyness. Again, mostly a quoting convention and used for definitions. And this table really tells us all we need to really know about moneyness for calls and puts. In the final part of the lecture, we will now look at the early exercise of American options, which is going to be an interesting topic that we're going to see is very closely related to the intrinsic and time value decomposition we did before. So before we dive into early exercise, let's review some key terms. So the style of an option governs when it can be exercised. Now in general, there's many different styles of options, but there are two main styles in the market that we will deal with in this class. The first style is the European option, And the second style is the American option. So let's start with European options. European options, recall, can only be exercised at their date of maturity. So each option has a maturity date, capital T. It can only be exercised on that date of maturity, capital T. Now, American options are slightly different in that they can be exercised at any time before maturity. That is, we know what this essentially tells us is American options are more flexible than European options. They can be exercised at any date t less than or equal to t. And so any strategy that you can implement with a European option can equivalently be implemented with an American option. So European options and American options are very similar, except for when they can be exercised. We know that Americans are more flexible than the European options because any strategy with the European can be implemented with the American. But we still don't know when it would be optimal to exercise the American option early, or when we would want to exercise this European option early, but we can't. It turns out that the answer to this question is surprisingly simple. It's going to just be as follows. Early exercise is optimal whenever the price of a European option is less than the intrinsic value on the European option. Or stated differently, whenever just the time value of a European option, or whenever the time value on the European option is less than 0. Okay? So early exercise is optimal whenever the European option price is less than its intrinsic value, or whenever the time value is less than 0. These two conditions are equivalent because remember, you can always decompose the European call or put price into its intrinsic value plus its time value. Okay. So this is a very general condition for when early exercise is optimal. Let's try and think of some specific examples. Okay. It turns out that for some options, early exercise is actually never going to be optimal. These are going to include two main types. First is call options on non-dividend paying stocks and calls on stocks with small dividends. So early exercises, we can prove that it's never optimal for call options on non-dividend paying stocks and calls on stocks with small dividends. The reason why these options should never be exercised is because the value you get from receiving the stock early or the dividend slightly early is not going to exceed the deferred payment value that you sacrifice. Okay. For other options, though, early exercise can be optimal. The two main examples of this are call options on stocks with large, potentially one-time dividends, and more intuitively, puts on stocks with really low prices. These types of options may be exercised early because they may have negative time values corresponding to either putting off a payment or in terms of receiving this dividend early. For example, on the next slide, we're going to deal with a practice problem on the early exercise of an American put. And in that example, what we'll see is that the holder of an American put may want to exercise the option early if the stock goes bankrupt. If stocks go bankrupt, the prices can't go any lower. So there's no value to still just keeping the optionality component. The only thing that will remain is deferred payment, and you want to receive that strike as early as possible. Okay. So that seems abstract right now. Once we do this practice problem, though, we'll see how it all fits together. So I'll give you about 1 minute to read this, and then we'll work through this. All right, so let's solve this problem. Okay, so the problem statement is follows. It's March 28th, 2000, it's March 2008, nearly the height of the financial crisis. Suppose you own an American put option on Bear Stearns, which was an investment bank with stock ticker BS, with a strike price of 120 and a maturity of 2 years. So Bear Stearns has recently gone bankrupt from uh, their holdings of subprime mortgage-backed securities and their writing of credit default swaps. And their stock is now worthless. That is, the stock price is $0 per share, and it is never coming back. The continuously compounded risk-free rate is 3%, and assume there is no arbitrage. We want to answer 3 questions. First, you have an American put option. What is the intrinsic value of your put option? It's the same as calculating it for European options. Suppose instead you own an otherwise identical European put, same maturity, same strike, instead of this American put option. What is the fair price of the European put option? And based on your answers to the above, should you exercise the American option early and why? Okay, like all problems, let's start by writing down our inputs. Bear Stearns has just gone bankrupt. Stock price today is $0. It's never moving again in the future. We luckily own an American put option on Bear Stearns with a strike of K equals 120 and a maturity of 2 years in the future. Okay, continuously compounded risk-free rate is 3%. In part 1, we're asked to calculate the intrinsic value of the put option. Okay, so always remember that the put option price, even if it's an American, can always be decomposed into 2 components. One is intrinsic value, the second is time value. Intrinsic value, again, is still just going to be the tangible value of the option, or the value of the option if you exercised it today. It's a put, so the value if you exercise today would be K minus S00, which is going to be equal to plug in inputs, 120 minus 0, 0, which is 120. So the put option has an intrinsic value of $120. Okay. The put is significantly in the money. Notice that the intrinsic value is exactly equal to the strike price. In part 2, we want to know what is the fair or no arbitrage price of an otherwise identical European put option. This problem's tricky because we actually haven't learned how to price European options yet, but we can use a simple insight to solve this problem here. The insight is that Bear Stearns stock price, since it's in bankruptcy, is never going to change. So either at today equals 0 or date capital T equals 2. The stock price today is 0, and 2 years from now it's still going to be 0. It's a bankrupt company. Okay? And thus, if we think about a European put option, the European put option has a price of P0 equals to what we want to figure out, and it has a payoff of equal to max K minus ST, which is S2, 0, which in this case we'll actually know beforehand. So at date 0, since we know that the stock price is never going to change, this eliminates all the uncertainty that's normally embedded in this put option. So we can actually tell that the put option's payoff in the future date is going to be 120 minus 0 or 120. Okay, so the European put option, we still don't know its price yet, but we for sure know that it has a payoff of 120 in the future. This payoff in the future is risk-free. We know what it is in advance. And so by no arbitrage, what has to happen is that the put option price of the European put at date 0 has to just be this cash flow discounted at the risk-free rate. It's no different than owning a discount bond with T equals 2 to maturity. So what we do is we just take that cash flow 120 and we discount it by the risk-free rate in order to get the price of this European put option. This is 120 times e to the negative risk-free rate 0.03 times 2. Plug these numbers in, check on your calculators. This should be around $113.01. Okay. So the price of an otherwise identical European put option is $113.01. The intrinsic value of the put option is $120. And we figured out the price because only in this certain circumstance could we know for sure what this future payoff on the put option was going to be. Finally, in part 3, what we're asked is we know what the intrinsic value is. We know the price of an otherwise identical European option. We want to ask whether we will exercise this European put option early. And all we have to do to solve this is look at these two conditions that we had earlier in the lecture. Early exercise is optimal whenever either the European option price is less than its intrinsic value or the time value is less than 0. Okay. And so we can just check if conditions hold. So check if conditions hold. Oops. Okay. So we'll start with the first. They're equivalent. We could just test either one. So we want to check if the European option price is less than the intrinsic value. Okay. The European option price, we calculated it in the last slide. It's 113.01. The intrinsic value is 120. We calculated this. 113 is indeed less than 120, which implies yes, we want to exercise this option early. You could equivalently do this in terms of time value. So you always remember that the time value is equal to the option price, premium, P0, European premium, minus the intrinsic value. This is equal to 113.01 minus 120. This, of course, is less than 0, which gives us the same exact answer. Yes, exercise the American option early. So why is this the case? Well, recall that this is the payoff of the European put. The European put has a price of 113.01, a payoff for sure of 120. The reason why the European put option price is 113 is because it has to wait in time to discount this back. It cannot exercise until date capital T equals 2. And so what happens is that the current price reflects this discounting that you have to wait to receive this payment. The American option instead can push this forward. So the American option pushes this forward. It doesn't have to wait. And so the price of this American option on this day has to equal 120. Okay. So that really wraps up the idea. Essentially, the American option is going to avoid this deferred payment penalty on the put. And so again, what the main idea is that the European options do not give you this added flexibility to exercise whenever you want. American options will exercise early for two specific types of options, in particular calls on stocks with large dividends and puts on stocks with really, really low prices. And the reason why is because for these options, the time value may be less than 0 on the European option. Okay. So in summary, we can decompose option prices into two components, intrinsic value and time value. And then we can also split time value into two further subcomponents, deferred payment value, which is positive for calls, negative for puts, and a potentiality value, usually positive unless there's early exercise going on. We then related intrinsic and time value to the early exercise of American options and also the moneyness. I posted a homework and quiz for this lecture on Canvas. Please complete this homework and I guarantee you'll do well on the quiz. All right, see you next time.